curation is not avoiding all risk. It's just packaging it so people are aware of what risks they are taking.
Steakhouse has established itself as a dominant player within this category. And I think a huge part of this is attributable to the reputation for security and having zero bad debt, while other curators or other teams within the space have collapsed,
And we want also to believe in the DeFi ethos to say, well, power to the people or power to the depositors at least. And so every time we create a new vault, we create a new decentralized organization. So everyone wants to grow. Now that's very clear. Everyone wants to do something. A workshop in London, there was only traditional finance people, and they were all excited to do something. We are really at the beginning. We didn't see anything. Currently, it's really fintechs, which are only starting to come.
Within the last years, risk curation has exploded and quickly become one of the most successful and profitable verticals in the crypto industry. In the years 2024 to 2026 alone, we saw risk curator TVL explode and grow from roughly $43 million of TVL to roughly $7.1 billion today. Within that category, Steakhouse Financial has emerged as a dominant player, securing today $1.7 billion worth of TVL, or otherwise roughly 24% of the overall TVL amongst curators. One of the more recent catalysts for this dominance has been the events of October and November of 2026. While Stream Finance collapsed, Elixir's DEUSD stablecoin depegged, and liquidation cascades caused users to lose hundreds of millions of dollars, Steakhouse had zero exposure, further reinforcing their position as an institutional-grade, resilient risk curator amongst competition. I'm Dylan Hansen from DIA, and today we're talking with Sébastien Derivaux from Steakhouse Financial. All right, Sébastien, welcome, thank you. So let's kick it off with just a brief introduction on yourself and your background, of course, get to know kind of where you came from and the drivers in your experience that led you to co-founding Steakhouse. I know that before Steakhouse, you led MakerDAO's RWA efforts and eventually led to the induction or the creation of $2.2 billion worth of allocation going into US Treasuries for MakerDAO. So if you wouldn't mind, I'd love to kick it off like this, just hear a little bit about your background and really what was the market gap or opportunity that you discovered while at MakerDAO or afterwards that led you to co-found Steakhouse?
Yeah, sure. So my background quite quickly. I have a PhD in data science, worked for different companies, financial banks, insurance, video games company. I worked on World of Warcraft and StarCraft 2, those kind of stuff. So plenty of stuff. And during COVID, like a lot of people, there was a lot of issues finding a new consulting engagement. And I had some free time. And I was on the Maker Forum starting to try to work on what is it in a DAO actually, so anyone can join. That was quite an amazing experience. And quite quickly, I started to lead the real world finance core unit, which job was to make financial reporting for MakerDAO, but also trying to innovate in the field that was called the real world asset. That was already present, and some people were already working on it, but there was still some missing pieces, especially on the MakerDAO side. So I was there to try to move these things forward. Plenty of legal, technical, community issues, because it's quite foreign for people at the time, at least, to have real world asset. You need to remember that in May 2020, Maker adopted USDC as collateral, and that was a complete mess because people were saying, well, it's the end of decentralized finance if you start to have USDC. Now, obviously, 6 years later, USDC is everywhere. So not much we can do about it. That ship has sailed. And so we were trying to start to do real world asset project with New Silver, with others. And then there was, as you mentioned, more investment in T-bills. Why is that? Because at the time, the T-bills rate was starting to move up again, because it was at 0% after COVID for quite some time. And it was a bear market, not this bear market, but the previous one, or the one before. I don't know how many bear market there was. I'm not tracking the price too much. But so the lending rate on Maker was 0%. So Maker was willing to lend DAI at 0% and no one wanted to borrow it. I mean, some people, but not enough. So there was a big pile of USDC sitting in what is called the PSM, the price stability module. And so the idea was to say, well, let's get outside of the DeFi box. Let's go in the real world, invest in T-bills. And that's what we did. First, off-chain, and then with the Spark Grand Prix a few years later, on-chain. And just before that, we were working at Maker, and I found my co-founders, Mark and Adrien, that were part of the real world finance team and then the strategic finance team. And we went on, well, let's not stop with Maker and let's work with other DAOs. And we started a shop called Steakhouse Financial to advise on many DAOs, especially on topics like financial reporting, which was a very important need for a lot of DAOs, and also real world asset. So we just started there as a consulting engagement. We had most of the DAOs. We worked with Arbitrum, ENS, Lido, and plenty of others. And more recently, we pivoted to say, well, let's make product, let's grow a bit, because we started just as a small boutique shop, just to make a few advisory on the side. And now we are a team of 30 people and the leading curator on Morpho. We are the creating vaults on Camino. I'm quite sure we'll go a bit more deeper on those. And we are also operating Grove, which is one of the prime star of Sky.
Yeah, excellent. Thank you. Yeah, quite interesting to me how risk curators kind of originated with this this risk curator kind of actual intention, right? In that actually analyzing risk, being able to actually provide this reporting standards for different crypto projects and whatnot. And as you mentioned, look into actually productizing this through vaults and whatnot. And as I understand it, and correct me if I'm wrong, I think vaults are really the main. I almost think to refer to them as vault curators at these days, but. Maybe are vaults the main core product these days, or are you still providing this overview of, risk as it relates to certain companies and entities? I suppose these are very intertwined.
Yes, I mean, Vault is one product, but sometimes if you are working, for instance, we are working with a bank, Société Générale Forge. Obviously, a Vault is part of the product, but we are also advising, so they are quite complementary products. For instance, if you look at Grove, which is more asset liability management or balance sheet management service we are offering to the Grove DAO, part of the Sky ecosystem, then having vaults, I mean, it's part of the allocation. They invest in vaults, and we can create vaults that match the requirements, the specific requirements of Grove. So there is a lot of synergies between all the line of business, the three line of business at Steakhouse, and so that's why it's also more exciting for us.
Yeah, excellent. Yeah, thank you. So maybe if we can zoom out for a second, and just for those kind of tuning in who might not be entirely familiar with a vault and haven't gone too deep, could you just start with like a very simple explanation of what a vault is, and then we can dive a little bit deeper from there. And really interested to hear your perspective. Who benefits the most from vaults? Is it retail investors, or is it institutions, or is it really collective?
Yes, no, very good question. So high level, you have DeFi, and for those that are here for a long time, it's complicated. Even for those that are full time for the last 6 years, there is plenty of yield opportunities, but it's very difficult and it requires a lot of due diligence to spend the time to understand what are the risks, what are the reward, how does it work. For instance, for some protocol, we spend 3 months trying to understand, analyzing the audits, making sure that what is deployed is actually what was audited, not as easy as it sounds. So it's quite complicated. So for most people, it's difficult to access the opportunities of DeFi because they are so bespoke, they are so arcane and complex. So a vault is just an abstraction saying, well, we provide a simple vault, which is, let's not go too deep technically, but ERC 4626, so very nice standards. You put a token, let's say USDC in, you get a share of the vault, or some shares of the vault, and then you are pooling capital with other people in a non-custodial way. That's important as well. And that will then, another party, the curator or the DAO, will be able to allocate this capital to the different yield opportunities and more or less do the clerical work of operating and allocating the flows. Mm-hmm. So it's a simplification of it's an infrastructure piece in DeFi to abstract the yield component of the DeFi opportunities.
Yeah, excellent. And to date, Steakhouse has established itself as a dominant player within this category. I checking the facts last night. It's about 25% of the total TVL within the curator category, and I think a huge part of this is attributable to the reputation for security and having zero bad debt, while other curators or other teams within the space have collapsed. If we look back to October 10th and November of 2026. This was a defining point, and from my perspective, in curator reputation. And Steakhouse emerged as, with a very, strong feat of having zero bad debt within this, and further kind of sharing its strong security practices. So, can you take us through what this looks like behind the hood a little bit? How has Steakhouse been able to achieve this? How does Steakhouse essentially differentiate itself amongst competition? When you see other curators, other projects failing or collapsing in such circumstances, how has Steakhouse built, a differentiation in establishing itself as being able to mitigate these types of risks?
Yes, for sure. So let me just put that curation is not avoiding all risk. It's just packaging it so people are aware of what risks they are taking. Because obviously some people want more risks. That's why we have the prime vault, which are the more blue chip, using only the blue chip collateral, and we have the high yield, which is a bit more exposed to risk for people that want to have a more exotic collateral, and usually there is a higher yield. Now we have a framework, but even on the high yield, we didn't get any bad debt on stream finance, and I will come back to that. But let's to lay out how we think about this. We have a risk framework. We are assessing each collateral to be added in 3 pillars, and we are going quite deep on each of those to understand and create a rating. So, for instance, usually for the prime vault, we are only taking, so we have the 6 letters, double A, very pristine. Currently, there is nothing. That shows also the state of DeFi. Well, maybe there would be ETH, actually. I think ETH is on double A. On ETH, on Ethereum, obviously only. But then it says collateral, so it's a fluctuate. Then you have A, which is quite good. I mean, it's quite wrap stake T's, CBBTC, those kind of stuff. Double B, B, double C, and C. And C, we never use it. The A and double A are used for the prime vault usually. On the high yield vault, we are sometimes going up to CC, but constrained, meaning we don't get full exposure to only one collateral that is CC. And how we are analyzing? We are analyzing the counterparty risk, we are analyzing the volatility risk, and plenty of others. Everything is documented on our website. I recommend people to go on steakhouse.financial/docs, and you will see even all the markets and their rating. But also we are looking at the audits, making sure that what is deployed match what is the audits. If there is an EOA controlling some assets, if could be plenty of things, what the protocol is investing, how it is evolving. So sometimes the protocol starts safe, but over time it gets more and more risky. So we are taking care of those. We are also putting in place some, we call them kill switches, which track a lot of events on chain. We are also using Hypernative for that. And if something strange happens, then we try to exit the market, or at least not allocate more. And if it's very serious, we exit the market completely, or we try to exit the market to safeguard the vault itself. So this is the overall layout, and that worked quite well so far. Obviously, it's always probabilities. You try to avoid the most likelihood source of issues, which are the single Cs, but it doesn't mean that a double C or even a double B will not have an issue. It's just that the risk is way smaller. One issue we have in DeFi is that we don't have so many diversification, because there is not so many collaterals that you can have. I mean, if we look at most vault, first, I think Morpho Vault V1s are limited by 25 collaterals. So that's not a great diversification in the TradFi sense, but usually it's mainly 3 to 5 big collateral. So you have a concentration risk, but that's just the state of DeFi today. So not much, sadly, we can do about it. To come to stream finance, it's quite funny because I I would love to for us to look smart, but it was very simple. We just had one line of exchange with the team because they wanted to get listed, or and I just say, well, you are just an unregulated leverage hedge fund. They say yes. I say, well, we don't add it because that's directly on the C line because it's too risky. There is some opacity. You have opacity issues. You don't have everything on chain and so on. So we didn't do a proper due diligence because it was removed quite early on. So we didn't knew much about it, just that it wasn't inside the risk appetite. And obviously, for the months before the crash, we saw a lot of outflows from our vault or the IE vault to the to some competitors that were exposed because the yield was better and people are chasing the yield. And then we lost a lot, and then it blew up. So we are still here. So I mean, end of the day,
Yeah.
it was fine.
Yeah. Thank you for taking me through that. And you mentioned hypernative. One of the things I'm always curious about is understanding to what extent this due diligence process is done in-house versus to what extent you guys are, leveraging and taking advantage of other intelligence providers, Oracle providers, other like essentially on-chain data analytics platforms. So when you guys are going through this internal due diligence process, yeah, maybe if you could just share a quick note on like to what extent is this done in-house versus, where are you leveraging and able to leverage confidently, external third-party due diligence?
I would say it's mainly internal. I'm trying to think about cases where we were using external parties, but actually it's not so many. Most of the time is spent, really on understanding the protocol. So that's and there is not so much, and just getting all the information. We have a DDQ, so a due diligence questionnaire that is quite extensive that we send to people, and it's always funny when say, well, you are the first creator to send us a DDQ because usually no one is asking anything. But actually, we ask and we try to understand, which is sadly taking quite a lot of time. So that's why we are usually also always a bit late to the party. And we are using some tools to track on chain what is going on. For instance, the development, the integration between the different smart contracts to see which one is called by which one. I don't sadly don't. It's an open source tool that is quite amazing because it provides a nice visualization, but I don't. I blank a bit on the name. But yeah, so not so much external tools. Alternatives is really here to Hypernative is a great tool because it provides real-time feedback, and so you can provide filters, and it will alert you when something is going on. And obviously, it's not alerting us as humans. We are really just enabling automatically some kill switch, and then we are analyzing. We always kill switch something, and then we analyze.
Understood. So essentially, due diligence is more comprehensively done in-house, but these external tools are probably supplemental or complementary for real-time monitoring, right? And having more kind of sight on real-time circumstances.
Yes, correct.
Okay, excellent, super cool. Yeah, I want to go deeper into one more kind of like differentiation aspect of Steakhouse, and then zoom back out to some of your thoughts, on the future and the state of the kind of curator vertical. And specifically diving into transparency and governance, I think this is one of the kind of distinction factors that Steakhouse provides in kind of enforcing these institutional grade controls. If I look through it here, this includes 7-day time locks, which is above the industry minimum or standard. Guardian veto mechanism. This is something I want to dive deeper into with you. And then Supervisor V2, which is a new control layer that ensures non-custodial guarantees. Maybe you can just take us through a high level here. Like which of these, is actually the most unique? For me, I want to go deeper into the Guardian veto mechanism. If I understand it, depositors actually become guardians to a proportional extent of their deposits and can veto curator decisions. I think this is super neat. Can you share more about kind of like the whole ideology of this and to what extent this actually plays a role effectively in curator decision making?
Yes, for sure. And the three elements, the time lock, the veto, and the supervisor are both three connected to achieve the same goal, which is to say full non-custodiality. Because if you are the creator and you can do whatever you want, and you can see on some vaults of the competitors, there is usually a guardian or a sentinel in the Morpho Vault V2 parlance, but it's usually the same multi-sig as the other ones. And so that's not non-custodial. So the only solution for people, let's say a creator wants to rug pull everyone. They add the bad collateral that they can mint. They allocate to it. They mint the collateral. They take all the money and leave. So that's something that can happen on any lending protocol, really. Obviously, the governance is different. In our case, we said, well, that's a risk. We kind of trust ourselves to do the right thing, but what if we get hit by a bus and our keys are compromised? You never know. At least we want also to believe in the DeFi ethos to say, well,
Yeah.
power to the people or power to the depositors at least. And so every time we create a new vault, we create a new decentralized organization, which is not by users of the vault. So for every vault, we have more than 100 now, I think. There is 100 Aragon DAO, where anyone having shares of the vault can go on on the Aragon website, get some. Sometimes they just need to log, sometimes they need to wrap it, depending on the version. Now it's just they just need to log, and they can vote to veto something. They can make whatever decisions they want, but the most important one are to veto something the creator has initiated. So it's optimistic governance, because obviously, if you want to vote on everything, I worked for DAOs for quite some times. I remember very well my time in the summer at MakerDAO, where no one was getting paid because all the governance token holders were on vacation and they were not voting. And so people weren't getting paid. So big DAOs don't move fast because it's complicated to get governance done. So we adopted a optimistic governance. We proposed something. There was 7 days, which was the longest at the time. Now for the prime, most people followed, but usually people were on 1 day, 0 day, or 3 days. Now it's really 3 days and 7 days. And there is 7 days for people to start to vote and vote against it. And what is we are the only one at scale at doing it. And it's very interesting is that you only need one person of all the depositors. I think we have more than 100,000 depositors to show up at Aragon, or to know how Aragon is working, or spending the time to make it work, to create the vote on it, wait 1 day, and then it can veto our decision. Someone with $1. So that's very neat. Obviously, if someone shows up with $10 saying, no, you are just trying to block the process, I will vote against you, then it doesn't work. But it's really a DAO in the sense of anyone with a deposit in the vault can vote against our decision. And it was quite scary at the beginning. We were assuming, well, a lot of people will vote, create vote, and vote against everything, just because competitors have an incentive to do it, just to mess up around a bit.
Yeah.
But actually, it never happened like that, because it's just too complicated. And if we had some collateral that are, obviously we never tried to rug pull. Maybe we should try to see what happens, but it's not what we want to do anyway. But yeah, even if you had some collateral, maybe some people can leave anyway. So maybe they are not going to vote; they just vote with their feet. And the supervisor is just to enable the same structure on Morpho Vault V2, which works a bit differently. So on Morpho Vault V2, we are the only one doing that. And to be totally transparent, I never saw anyone caring too much. Some people like it, but it's not a decision driver for people to allocate.
I think, yeah.
Which is a bit sad.
So I'm seeing, of course, the connection here now to your time at MakerDAO, right, and then into kind of the voting process here. And how do you look at delegation? How do you consider this, right? I think as you mentioned, kind of the ideology behind vaults is to, enable complex strategies to be accessed by the average user. So how do you look at this? Do you guys embrace delegation in terms of, allowing and delegating your vote essentially to somebody who you think might have more intelligence on a decision, or are you guys averse to that for a specific reason?
So on the vote itself, we are really optimistic because also we want to make sure that there is no governance attack where someone can just make a bad decision. So we are initiating, so we are kind of the first filter, but then the governance can veto whatever they want. But at least you don't have an attack like I think there was an attack of Compound a few days ago that was not successful, but still it's quite challenging. And there was on MakerDAO once in the past. So it's when you have many votes, it will be more challenging to make sure that governance is fine. But for instance, to answer your question on Morpho, because we have some Morpho tokens, we are delegating all the voting power to someone, to one party. And we are not taking much action or governance time on the Morpho side, and we are letting it to the delegate, which is more effective than us, because obviously we need to run votes. We don't have time to do governance.
Okay, super clear. Yeah, thank you for that, for the explanation on that. I'd like to zoom out a little bit away from the governance and security aspect. And for me, on a personal basis, one of the kind of the questions I find to be most interesting is looking into the specific types of assets that Steakhouse, is curating, is including in their vault. When I speak with curators in the past, it boils down to obviously security of a given asset, but also I've been informed that teams are mainly looking at where the borrower demand sits. Do people actually want to borrow against these assets, or rather borrow these assets? But I'm sure it's a lot more comprehensive than that. So I'd love to get your expert overview of really what is it when looking at what assets to include, and then in which vault to include a specific asset. How does this look also behind the hood?
Yeah, sure. So high level, we are a piece of infrastructure. So we have a risk framework, and so we could add all the collaterals. Except in reality, we don't have an infinite bandwidth. So we need to prioritize what we are looking at. And to your point, yeah, there are some collaterals that we know are single C, so we will not look at them, or they are not acceptable for us, or at least under our risk framework. Some that are small and we don't see borrow demand, so we will spend more time on those that we think are more worthwhile, and some that could be good, but we know that if we try to add it on some vaults, some LPs will try to veto it, because usually when you have a big depositors in the vault, you're asking first before adding the collateral. So that's why there is not so much contention on the voting side, because you first ask off-chain before going to an on-chain veto, which is not usually not great. So to your point, you need to have a sufficient level of yield, safety. Obviously, that's safety is the first one, but also a yield. Let's say you have and demand. For instance, one thing that if you take a cryptocurrency, a very small one. So for instance, if you take Morpho as collateral, something you can ask yourself ourselves: why don't we lend against the Morpho token with Morpho vaults? But actually, the only reason then it's a risk issue because there is not enough liquidity, and the liquidity there is on the market would allow us to lend maybe 1 million against Morpho, and making just something for 1 million is not making any change, and it's not super useful. Especially as on Morpho, the more collateral you add, the more gas you consume, and there is a hard limit as well. So you need to be a bit more tailored. So there are some assets, yield-bearing stablecoin with incentives, bundle tokens, those are working well. You have now, we did 2 private credits. Those you might say, well, that's a bit funky, taking a bit of risk, but actually on MF1 we spent 3 months to make the product worthwhile, and we have it in our vault for 9 months now. There was some crypto Twitter drama 6 months ago, but no bad debt and a very good performance otherwise for lenders. So that's what we are looking as kind of collateral. And the next stage is more real-world asset, I would say. That will be quite hot, but it's still TBD how it will grow. You can see that some lending protocols have added some stock index like the SPY or QQQ. Not a lot of borrow demand, partly because it's a volatile asset. Who wants to leverage on that? It's difficult to leverage. You will not go 10 times leverage on the Nasdaq index. I mean, at least I wouldn't, and I wouldn't assume it's safe. So there is a pair market for that, I'm quite sure, but this works more on the pair market than on the lending protocol, because if borrowers get liquidated too often, then the market dies because borrowers don't have money anymore.
Mm-hmm. And so, what does this look like, as you mentioned, in the scope of private credit? With crypto tokens, you mentioned, of course, liquidity is a huge aspect of your kind of due diligence process. Can an asset be liquidated? But how does this look within the scope of private credit, assuming that there's not on-chain liquidity for these types of
So,
exposure?
yeah, that's a good question. For instance, for Faznar, we put on-chain liquidity. That's why in the MF1 token, there is 10% that is liquid. There is also ways to get liquidity more. There are side deals to make sure there is a liquidator of last resort. And it's funny because we spent quite a long time and we stressed quite a lot about how to make sure there is always a liquidator. That's why, for instance, on the Morpho market, if you look at it, there is a price of the token, but for Morpho market, we put a discount at 7.7% just to increase the liquidation penalty so someone shows up to take the liquidation penalty. In hindsight, maybe it was too big. I mean, overall, you earn 10%. You have a 10% discount if you liquidate this token. And there was one example, it was Stream Finance that was close to get liquidated. And I know that everyone I know was trying to snipe it to get to be the liquidator.
Right.
And sadly, no one was succeeding. There was no liquidation, but yeah, everyone was rushing to make it to liquidate it. So I don't think private credit will scale, because obviously you can do it up to a certain size. You can have off-chain deals up to a certain size. You cannot have billions of liquidity of last resort. That's not possible. That would be just too expensive. So I think we will move more on more liquid collateral. But last year, at the rate that lending protocol were doing, so it was you were borrowing at 6-7%, you needed something that was yielding more to make sense, and private credit was the right approach. Now,
Mm-hmm.
currently, you can borrow at 5%, 4-5%, so that's a very different market. Depending on the market, the kind of collateral is not the same.
Yeah, this is one of the things I'm fascinated by when we look into real world assets, because you can effectively, tokenize an asset, bring it on chain, kind of have it backed in some, some SPV or like a British Virgin Islands entity or something like this. But I'm very fascinated by the actual redeemability of these assets. I think that this, for me, as I look forward, is a big needed unlock, and perhaps likely something you guys are already internally doing the due diligence on. But as like an external third party, such as something like Hypernative, like a public resource for accessing real-time information on assets, I think that this is a big unlock personally. What is the redeemability of a certain asset? Who are the liquidators exactly? How can this be actually liquidated if most of the collateral is sitting off chain? So just thought I'd add my kind of curiosity to that. But I want to pick your brain on where you think this is all heading. It seems currently there's a bit of a consensus that vaults have proven to be the flagship DeFi product for accessibility, users and institutions. Do you agree? Do you think that this is the flagship product? Do you think that there's still, maybe this is actually a pretty three-part question here. So let me zoom out. Do you think that this is the flagship product for institutions?
It is a flagship product to bring institution or to bridge towards institution. I mean, if you look at before, and the first Vault, there was Yearn. It was, I think everyone agrees that it was the first Vault version. Morpho created the curator, so it was a bit more productized in a way. But what I see, since we won the partnership and the partnership with Coinbase, where people on the Coinbase app, not the Coinbase wallet, but the Coinbase app, were able to lend on Morpho through a Steakhouse vault. Every fintech and every institution is looking at it. And we are announcing a lot of partnership. I mean, I can barely follow myself just for the Steakhouse ones. And I'm quite sure our competitors are signing deals as well. So it's really moving forward. You can see plenty of integrations. So currently it's quite fintechs. I think the last one was D-Block integrating 104 Volt, which is an app more in Europe. But we have plenty of others. And so fintechs, custodian, regulated custodian. We are now live on Anchorage, which is a regulated bank, actually in the US. The next stage will be even more usual financial institutions or more traditional financial institutions. So that's how it's growing. We also see how traditional asset managers are now like, well, if DeFi is coming to us, we need to go to DeFi. So that's where you are seeing, I think it was Bitwise going to the Vault business, and plenty of others will follow. So there will be more competition, but we welcome competition as long as we win. So we will see what happens.
Yeah, that's excellent. Definitely interesting to see the interesting curation growing amongst traditional financial companies like Fidelity. I think it was on my timeline. It might have went viral on X that they were hiring for a DeFi curator strategist role. So yeah, really interesting here. And as somebody who's directly in these conversations, do you feel that the unlock has already happened, that this is just based on time until all this capital starts to move on chain? We're already seeing huge inflows of institutional capital on chain. Or do you feel that there's still blockers here? So, blockers such as transparency, security, maybe even education towards institutions. I think this is obviously most people's questions here. I flag it as like the $1 trillion question, but like, is it here? Are vaults good enough to kind of really engage and reach the total mass of institutional capital? Or do you see, as one who's in the room, there's still some hesitation on some of these specific blockers that they're flagging?
So everyone wants to go. Now that's very clear. Everyone wants to do something. Now the question is more on the how. We still have, I mean, some education, as you mentioned. I mean, just a workshop in London. There was only traditional finance people, and they were all excited to do something. But that somewhere a few years, it will take a few years just to get up internal approval to start something. But everyone wants to do something. Now the question is mainly compliance, because, for instance, if you look on Base, you have the Coinbase users that are lending. Lemon is lending as well in the same vault or the same markets. So that creates a full ecosystem based on the same markets. And that creates a lot of liquidity, and that's very good for borrowers or for anyone really on those financial markets. Now, some institutions are more, well, maybe we need to be permissioned and a walled garden. But then you just have a walled garden on the side, but you are segregating the liquidity. And then you have some user providing, but you don't have borrowers, and so it's a very complex problem we see those days when we try to bootstrap. That's one of the key projects we have at Steakhouse, to bootstrap new stablecoin currencies, or new stablecoin even in US dollar. It's very difficult to bootstrap a Euro stablecoin, a Japanese yen stablecoin, Brazilian stablecoin, because you need to find lenders and borrowers at the same time. While on US dollar, I mean, there is already plenty of liquidity, so you will find someone will arbitrage the rate. So to come back on the institutional side, I would say everyone wants to come. We are really at the beginning. We didn't see anything. Currently, it's really fintechs, which are only starting to come. I mean, Coinbase was the big one, but maybe it was more a crypto company than fully a fintech. But now every fintech is coming. Morpho announced a partnership with Privy that we are part of as well. So we are creating the rails for all fintechs to come. And the next wave will be the financial institution. But probably we will need more regulatory clarity before the next wave. But
Sebastian,
it will be exponential.
yeah, well, Thank you. Thank you, Sebastian, for sharing that. I think it's always great to end with well, I prefer to have an optimistic outlook. I think this space is built on optimism and competition, as you mentioned. So thank you for coming and sharing today all that you guys are doing to actually advance the usability, the accessibility, and the success of this space, and for joining us on Beyond Yield today. Before we jump off, any last thing that you want to add? Maybe if you could share some insights into where people can go and learn more about Steakhouse. Somebody wants to go try out the vaults and learn more. Where can they go?
Yeah, they can go on the Steakhouse.financial website that we have. They can also follow us on Twitter at StakeHouseFi. That's the handle, but you can find it on the website as well. We have a new app where we can access more morpho vaults, but also some vaults that are not available anywhere else because we are creating new products that are more. We are expanding the universe of vault if you want. So yeah, the website is the best source.
Excellent. Yeah, thank you. And for those listening in, thanks for joining us for Beyond the Yield with Steakhouse here.
Thanks
And
for having me.
yeah, cheers. Thank you, Sebastian.